Hello guys, in this video we are going to see about ratio analysis. If anyone not yet subscribed our channel, kindly subscribe, bookmark. Ratio means we are comparing two values. Ratio analysis means by comparing the two values we are analyzing something. In this case we are analyzing to find out the financial position of the company. You may have the doubt that we can able to find the financial position of the company by knowing balance sheet and then profit and loss account. Then why we need to go for ratio analysis? See, by knowing balance sheet and profit and loss account, it is very tedious process to find out the financial position. By knowing the ratio analysis, we can be able to find out very easily. Classification of ratios. There are totally two classifications. One is traditional and then functional. That traditional classification is further classified as profit and loss account, balance sheet ratio, and then composite ratio. Composite ratio means combination of profit and loss ratio and balance sheet ratio. And then functional classification. Functional classification is classified as profitability ratio, turnover or activity ratio, financial or solvency ratio. This solvency ratio is further classified as short term, long term. This short term usually called as liquidity ratio and long term we will call as solvency ratio. In this chapter they explain only about functional classification. Okay, mostly we are not using traditional classification. The reason is, as we said earlier, traditional classification we have to analyze balance sheet and income statement. It is too crude and unsuitable. Okay, we came to ratio analysis because that balance sheet and profit and loss account is tedious. For that purpose only we came to ratio analysis. In traditional method, anyhow, we are going to use again balance sheet and then profit and loss account. So instead of using traditional classification, we will go for functional classification. What are the uses of accounting ratios? As we said earlier, simplify financial statement. We can able to find the financial position of the company very easily, and then facilitate intra-firm comparison. We can able to compare one company to another company. Okay, by comparison we can able to find out whether it is successful or unsuccessful. Then we can able to find out that firm is weak or strong, overvalued or undervalued. Then facilitate intra-firm comparison. If a company having 3 to 4 division, we can able to compare within the company from one division to another division, so that we can able to check which division is doing performance good or not. Then help in planning. With the help of ratio analysis, if we find out any problem may arise in future, we can be able to rectify by implementing some changes as on now. Okay, for that ratio analysis will be help in planning. Next, limitation of accounting ratios. First we see what is accounting ratios, then only we can able to understand the limitations. So these two pages we will see at last. Okay, see, straight away they go to functional classification. They didn't explain about the traditional classification. First one is profitability ratio, then solvency ratio, third one, and then lastly turnover ratio. In this unit they explained only about functional classification. In profitability ratio, first we will see about overall profitability ratio. It is also called as return on investment. Formula for this is overall profit divided by capital employed into 100, but different accountant using different meaning for capital employed. Some of them are listed below. First one, sum of all asset, whether it may be fixed or current. Second one, only fixed asset. Third one, long-term fund employed. Long-term fund employed means share capital, reserve and surplus, and then long-term loans. Why we consider long-term loans means, anyway, you are taking a loan for long term, it may be 10 years, 15 years, that loan amount you are going to invest in the company. So anyway, you are not going to take that amount back. So it is considered as long-term fund employed. Then non-business asset and fictitious asset are excluded. Okay, now most of them are using third point only. Okay, capital employed means long-term fund employed in the business is known as capital employed. What is operating profit? Operating profit means before interest and tax. Interest means only on long-term borrowing. If it is an interest for short-term borrowing means we have to deduct. For example, profit is 1000 rupees, tax is 100, and then long-term borrowing interest is 80 rupees, and then short-term borrowing interest is 20 rupees. So what they give, operating profit means profit before interest and tax. So no need to take tax and long-term borrowing interest. Okay, but short-term borrowing means we have to deduct. So 1000 minus 20 equal to 980. This is known as operating profit. Interest and tax should be excluded before interest and tax. Interest means only for long-term borrowing. If it is a short-term borrowing, we have to deduct. Significance of return on investment. Suppose if the return is more, the business is efficient. Suppose return is very low, it is inefficient. Next one, earning per share. Return on investment is a popular method. Okay, but we can't use this method for comparing two or more firms, because two or more company cannot be in the same age or same size. Since it cannot be same size or same age, we can't be able to compare them based on the return on investment. So for this purpose, we will find out the earning per share. Per share, how much income it is generating. Okay, then with that value, we will compare the two or more company, so that we can be able to analyze which company is doing better performance. Formula for earning per share equal to net profit after tax and preference dividend divided by number of equity share. Before reading the formula, make note where they mentioned before and after. Here they mentioned before interest and tax. Here they mentioned after tax and preference dividend. Okay, while reading the formula, make note of this. Don't get confused. Okay, see, suppose a company having net profit after tax and preference dividend is 1000 rupees divided by number of equity share is 100. It means 10 rupees is an earning per share. Let it be for company A. Suppose if company B earning per share is 12 rupees. Okay, then which company we will use to invest, or which company is doing better performance? Company B, because company A giving only 10 rupees per share as in returns, but company B is giving 12 rupees as in return. Okay, by this we can be able to decide whether to invest or not. Next one, price earning ratio. This ratio indicates number of times earning per share is covered by the market price. Suppose earning per share is 10 rupees, but in market it is trading at 40 rupees. Okay, then formula for this is market price divided by earning per share equal to 4 times. Okay, it means that value is 10 rupees only, but in market it is trading at 40 rupees. It means 4 times higher than the original one. So this ratio indicates the number of times that earning per share is covered by market price. Okay, this one is company A. Similarly, company B earning per share is 15 rupees. Market value it is trading at 30 rupees. It means 30 by 15 equal to 2 times. So PE ratio for company B is 2, for company A is 4. By seeing this, we can able to identify that company A is overvalued. Already it is trading 4 times higher than the original one. We don't know whether it may trade higher than this or not. By seeing this, we can decide whether to invest in company A or company B. This is 2 times higher than the original one. This is 4 times. This is 2 times. So better it is to invest in company B, or we have to wait for some times to reduce. Okay. Next one, gross profit. Where we are going to use gross profit ratio. If you are having company, you are selling some product. Okay, now you are having an idea to reduce the price of the product. By reducing the price of the product, it should not affect the business, or it should not lead to any loss to your business. How to calculate that one? How much amount if we reduced it will not affect the profit of our business. For that purpose, we are using gross profit ratio. Gross profit divided by net sales into 100. Okay, gross profit means it includes everything. Your profit, see, to include everything, profit, charges, dividend, everything it will be included. Okay, so gross profit ratio is to check if you reduce the price on your product, that company will generate a profit, or it may be lead to a loss, something like operating losses. Next one, net profit ratio. Net profit ratio formula is net operating profit divided by net sales into 100. This is an exact thing to find out the effective measure to check the profit of the business. If anyone not yet subscribed our channel, kindly subscribe, bookmark. In next video, we will see the solvency ratios. Thank you.